everyone, a very good morning to everyone. I hope you all are fine and doing well. So today module B day, and today we are going to cover some MCQs of module B. So let's start with the class and let's see some questions. In this, basically I will ask some questions to you. You have to give the answer by analyzing the options. And one more thing, that this module is completely depends on risk management, right? So let's start. There is the first question is there in your screen, that what is the main difference between risk and uncertainty? What is the main difference between risk and uncertainty? See, we can say that risk is basically, risk can be measured because we know that what to do in the risky situations. But uncertainty, this is completely sudden type of things that causes loss. So here we can say that risk is measured because uncertainty is wide if we compare with the risk, right? So uncertainty we can't measure, but risk can be measured. So the correct answer is there, option B. In which of the following situation is there the least risk here? Least risk. Which of the following situation is having the least risk? See, here the correct answer is option C. Why? Because when we invest in the RBI bonds, that RBI bonds, government securities, these all are having zero risk. They include zero risk. That's why we can say that investing in the RBI bonds at a fixed rate is having zero risk investment. So this is the situation that is having the least risk. Why is RAROC considered a better measure of performance than ROA and ROE? Give the answer of this, that why this RAROC? Just a minute. So here what we can say, RAROC is considered as a better performance of measure because it accounts for the amount of risk taken to earn the returns. It use the amount of risk that is taken just to earn the returns. Clear? Next, if there is a business which is having high variability in the net cash flows, high variability means high changes, a lot of changes, that will require what? High variability in the net cash flows will likely to require what? I think when the business which is having high variability, right? So in these types of net cash flows, they require more capital, because already there is lots of loss just because of changes in the net cash flows. So they require more capital due to high risk of loss, right? High risk of loss, and capitals are work like a cushion for the banks in the times of problem. So more capital due to high risk or loss is required when business is having a lot of variability in the net cash flows. Why is this risk management essential for business continuity? Why is risk management is essential for business continuity? I think in any business, every business even, that survives on profit and stability. Obviously, when these both are having in a company or in a business, so they can compete in the competition, right? So basically, risk management helps for business continuity. Why? It controls the losses within capital capacity. That is great. Risk management is able to control the losses just within the capital capacity. Next, what can happen if risk is not properly estimated in pricing a product? When a product is priced, what can happen that risk is not properly estimated? See, here the answer is it may lead to loss of business or reduced profit. Obviously, when risk is not properly estimated in pricing a product, that will lead to loss of the business as well as there is reduced profit. What is the primary responsibility of the risk management committee at the board level? What is the primary responsibility of the risk management committee at the board level? I think the next committee after board of directors are risk management committee. So they are set all the risk guidelines, they set the limits, they ensures robustness of the models. So option C is correct here. They set risk guidelines, limits, ensure the robustness of model. So which committee is primarily responsible for managing the liquidity and recommending lending rates like MCLR, RRLR, which is the primary responsible for recommending these types of lending rates. According to me, the correct answer is Operational Risk Management Committee. They are responsible for liquidity management as well as they are responsible for the management of the benchmark rate, lending rate like MCLR and RLLR. So, which of the following is an example of basis risk in the banking transactions? Basis risk in the banking transaction. When the interest of the loan is linked to this MCLR while deposit interest is fixed. So the correct answer is option C. This is the example of MCLR. What is the purpose of downside potential as a risk measurement tool? Downside potential at a risk measurement tool. These downside potential is just there is the concept that assess all the potential loss, all the extreme type of loss that will occur in the adverse conditions, severely adverse conditions. So to assess the potential loss in the severely adverse condition is the purpose of downside potential at risk measurement tool. So which of the following best describe the limitation of sensitivity analysis in the financial risk measurement? That describes best the limitation of sensitivity analysis in the financial risk measurement. Yes, it assumes only one market factor changes at a time. Sensitivity analysis just assumes that there is changes in a one market factor at a time is the limitation of sensitivity analysis. Suppose if a bank wants to estimate the volatility of a stock using its daily volatility, which formula should it use? I think option C is correct. Monthly volatility is equals to daily volatility multiplied by square root of 30. Why is downside potential considered a better risk measure compared to simple volatility in the financial risk management? Why is downside potential considered a better risk measure compared to simple volatility because it focus only on the adverse deviations, only on the adverse deviation. That's why downside potential is considered as a better risk measure compared to the simple volatility in the financial risk management. In a risk based pricing, which of the following is not a direct cost that bank consider while pricing the loans? Which of the following is not a direct cost that bank considers while pricing loans? Borrower's past credit score. Why? This is not a direct cost that bank considers. So we can say that whenever banks are doing risk based pricing, only borrower's past credit score is not a direct cost that banks consider while pricing the loans. So which of the best describes the primary objective of a bank risk monitoring and control function? Obviously, they are ensuring that they achieve all the risk adjusted returns within the capital constraints. Why the risk monitoring is there? Just to just for the banks, so banks can earn a profit within their limits. Why it is important for the risk management function to be independent from the bank operational departments? Very good morning. I'm fine. What about you? So, why it is important for the risk management function to be independent from the bank's operational department? Obviously, it prevent conflict of interest in risk taking decisions. Means any type of uh, any type of quarrel, any type of dispute is there in the interest when taking the decision related to the risk. So it is important for the risk management function to be independent from the bank operational departments. What is the primary trade-off involved when a bank adopt risk mitigation strategies such as contracts and hedging? Just a second, give the answer of this question. So what is the primary trade-off here? That is reduced the risk but limited upside potential. Reduced risk but there is limited upside potential. That is the primary trade-off involved when a business adopt any risk mitigation strategy. So, which of the following is not a component of a COSO enterprise risk management framework? Which of the following is not a component of COSO enterprise risk management framework? Marketing strategy, objective setting, risk response, monitoring, all are these are the component of COSO. Why is operational risk considered one of the most critical risk in the banking? Why is operational risk considered one of the most critical risk in banking? Because it can lead to the severe losses, reputational damage, and regulatory issues. These are the things, that's why operational risk are considered as the most critical risk in the banking. So, what is the common goal across all the banking business lines, whether it is trading, retail, or asset management? What is the common goal across all the banking business lines, whether it is trading, retail, or asset management? Evaluate every option. So here everything is just there for the returns. So enhancing the risk adjusted expected returns is the common goal across all the banking business lines, whether it is for trading, retail, or asset management. Is that clear? Next question. Which of the following best explains why the banking book is not exposed to the market risk? Because banking book as hold it assets until the maturity, and obviously that does not use mark to market accounting. So banking book is not exposed to market risk because it hold all the assets until the maturity and does not use any mark to market accounting. What is the major difference between the trading book and the banking book in terms of accounting and risk exposure? What is the major difference between the trading book and the banking book in terms of accounting and risk exposure? Give the answer here, just read the options. here the correct answer is option C, because trading book use mark to market accounting and it is exposed to the market risk, whereas banking book is not exposed to the market risk. Banking book is not using mark to market accounting. What best describes off balance sheet exposure and the associate risk to a bank? In the given four options, different scenarios are given. So you have to tell that what best describes an off balance sheet exposure and associated risk to a bank. See, here the correct option is option C. There is a potential obligation that does not appear on the balance sheet initially but may result in the future cash outflow. These off balance sheet exposures are there, does not appear on the balance sheet but obviously result in the future cash outflow. Which of the following situation best demonstrate basis risk in interest rate risk management? Which of the following situation best demonstrate basis risk in the interest rate risk management? I think the correct answer is option C. When a bank funds 2-year floating rate loan with a 2-year fixed deposit. So this is demonstrating the basis risk in interest rate risk management. When a bank funds 2-year floating rate loan with a 2-year fixed deposit. Which of the following best illustrate basis risk in interest rate risk? Which of the following best illustrate basis risk in interest rate risk? See, a bank uses a floating rate deposit that is linked to the 90-day treasury bill to fund an asset that is linked to 364-day treasury bill. When a bank uses a floating rate deposit that is linked to the 91-day T-bill just to fund an asset which is linked to the 364-day T-bill. Which of the following is not a part of operational risk as per Basel definition? I think transaction strategic risk, okay. Compliance risk is the part of operational risk because it happens due to the process. People are not following the rules. Transaction risk is also process when there is error in any server or software. Legal risk is also the process. So the only thing is there, that is the strategic risk is not a part of operational risk as per the Basel definition. Suppose there is a bank that lends heavily to a company that depends on only the fossil fuels. So, new government policies promote electric energy and impose carbon taxes. So, which type of climate risk is there? Because we have two types of climate risk, right? So, give the answer of this option. Just a minute. Here the correct answer is completely, this is the example of transition risk, because we are having two types of risk: physical risk and transition risk. And when there is the shifting towards economy, so that is the example of transition risk. What is the primary reason for regulating banks and financial institutions? What is the primary reason why all our banks, why all the banks are running, why they are doing these much things? So obviously they are just protecting the depositors, and also they are ensuring that there is financial system stability. So to protect the depositors and ensures that there will be financial system stability. What is the systematic risk? Systematic risk or systemic risk is basically one of the dangerous risks, because that affects the whole economy. That affects the whole economy. So we can say that risk that one bank failure cause widespread disruption across the financial system. So option C is correct here. Risk that one bank failure causes widespread disruption across the financial system. So why was the Basel Committee on Banking Supervision established in 1974? Why was the BCBS established in 1974? Because to address the risk which are associated with the global banking, they are following the failures of Bangkok's her state. After this failure, banks thinks that it is important to follow the global uniform banking rules all over the world. So that's why this Basel Committee on Banking Supervision established. What is her state risk and how did it lead to global banking reforms? The great answer of this option question is option B. Basically, this bank fails while completing a cross border currency transaction, right? Due to which counterparties loses the money. Due to time difference, this her state bank is unable to complete cross border currency transaction on time, and that leads to counterparties, they started losing the money. So that's why option B is the correct here. What is the primary objective of Basel I Accord that established in 1998? Basel I Accord. I think the option C, they are just here just to establish minimum capital requirement which is linked to the credit risk of banks. They are establishing minimum capital requirement just that are linked to the credit risk of the banks. So, which is the true about the market risk amendment introduced in the Basel I 1996? See, according to the answer, like which of the true is, basically in this market risk amendment, value at risk introduced, these models are introduced just to calculate the capital which is required for the market risk. Value at risk models are those models that helps in estimating the extreme loss situations and they are responsible for calculating what is the capital required for the market risk. So, which of the following attribute reflects the pivotal transformation of Basel II credit risk methodology via Basel I static risk weight regime? Transformation of Basel II. Here the correct answer is integration. Integrate all the internal credit assessment mechanism via the IRB approaches. So this is the correct answer here. Under the Basel II Accord supervisory framework, what enforcement mechanism undergets a regulator prerogative to impose differential capital thresholds on institutions with deficient risk governance framework? I think the correct answer is promoting the corrective action protocol, which is important, taking correct action measures that are important while solving any issue, right? Which among the following best encapsulates the rationale behind the introduction of the leverage ratio under the Basel III framework? which among the following best encapsulates the rationale behind the introduction of leverage ratio under the Basel third framework? Currently we are following this Basel third and three pillars are there. Basically they reinforce non-stop weighted backstop that curves excessive on and off balance sheet leverage. They are reinforcing a non-risk weighted backstop and curves excessive on and off balance sheet leverage. What macroprudential objectives is served by counter-cyclical capital buffer introduced under Basel III? What macroprudential objective is served by counter-cyclical capital buffer that are introduced under Basel III? I think the correct answer is they are moderating the systematic vulnerabilities during credit expansion cycles. These are the macroprudential objectives. They are moderating the amplification of systematic vulnerabilities during the credit expansion cycles. Then I think yes, under pillar 2 of the Basel framework, the internal capital adequacy assessment process primarily aims to, under pillar 2, ICAP primarily aims to it helps the bank assessing their internal capital needs, which is based on full risk exposure. So ICAP help the banks, they can assess their internal capital needs, which is based on full risk exposure. So the correct answer is option C. So the next question, which of the following best distinguishing market risk from market liquidity risk in a bank trading book? Yes, market risk is completely related to the price volatility, while market risk is when they are enabled to sell the assets in the market at, or they are able to sell the assets but they are getting very low prices for their assets. That is the only difference. Which of the following best explains the rationale behind the middle office being functionally independent from the treasury in the context of market risk management? So read the options here. Which option is correct here? So here the correct answer is the it ensure unbiased autonomous risk measurement and validation that mitigate potential conflict of interest. So middle office are completely work for this, that basically ensure there must be unbiased autonomous risk measurement and validation. So in a scenario where a bond portfolio demonstrate a basis point of 85,000, what does figure denote in technical market risk measurement terms? That is 0.01% changes in the interest rate. So option C is there. Sorry, okay. Which among the following best encapsulates maintaining an autonomous credit risk management department that is different from the credit administration function? Why? Because they are independently enforce credit policies without operational interference. So the correct answer is option B. Okay, within the governance framework of bank credit risk management structure, which entity is primarily entrusted with policy formulation that concern risk concentration, asset classification thresholds, and financial benchmarks? I think who can do this? Risk management. Okay, credit risk management committee is responsible for these all things. Okay, which of the following best explains the concept of rating migration in the context of a bank internal credit rating system? I think rating migration can be signifies the movement of borrower's credit rating to a obviously it signifies the borrower's credit rating to a different risk grade over the time under the same rating model. So the correct answer is option B, that signifies the movement of borrower's credit rating to a different risk grade over the time under the same rating model. Let's see the last question for today. Which of the following best explains the concept of credit portfolio value at risk in the context of credit control at portfolio level? Concept of credit portfolio value at risk. Credit portfolio value at risk is there estimating the potential loss in a portfolio under normal market conditions over a specific period. So it estimate the extreme loss situations. Got it? So with this I think we completed near about 50 questions today, right? 50 questions today, and apart from this I will upload the PDF with the answers. So go through with these PDF. So it will help you to do the it will help you, you can do practice in regard of module B. So that is it from my side for today. Let's meet in our next session. Till then, take care everyone and have a good day. Thank you.